Our first speaker is Sid Norris. Sid has been an active investor, trader, and student of the financial markets for over 30 years. Since 2010, he has provided market forecasts for subscribers at his website, elliottwaveplus.com. Sid is best known for pioneering new ways to improve the accuracy and usefulness of the wave principle. In 2013, he started integrating Hurst cycle analysis into his Elliott Wave counts with the objective of removing directional bias. Over the years, as his understanding of how to combine Hurst with Elliott evolved and improved, his subscribership grew substantially. Today, Sid is best known for taking Elliott Wave theory to the next level by combining it with additional robust methodologies, thereby creating higher confidence and less subjective trading forecasts. Over to you, Sid.
Thank you for that introduction, Jody. And my name is Sid Norris. My website is elliottwaveplus.com. I'll show you that website in just a few seconds. I've got 1 hour today, and I've got a lot of things to cover. And I've built a little outline here to show you what I'm going to reveal during the next hour. Number one, we're going to look at bonds, and I call it a recession watch. This is a chart of the 10-year bond yields versus the 2-year bond yields. And well, at the same time as we're looking at bonds, we're going to also take a look at commercial sentiment positioning on 30-year bonds versus 10-year bonds. And I'm also going to take a peek at Japanese yen and the carry trade unwind. The reason I'm going to look at that during the bonds coverage is that the Japanese yen is highly correlated with bonds, and they tend to move together very reliably. And then I'm going to go over the S&P 500. We're going to look at the multi-timeframe wave counts, including an alternate count. But I'll be looking at starting at the quarterly chart, so a 100-year chart, and then moving to the monthly, weekly, and daily charts. I'll also show you some Hurst cycle analysis on the S&P. Then we'll move to Bitcoin. I want to show you my weekly and daily wave counts. I also want to show you my Elliott wave count and associated Hurst cycle analysis on a stock called MARA, M-A-R-A, that is a large Bitcoin mining company, and show you how there is quite a difference between the Bitcoin wave count and the MARA, and I'll discuss why that difference is apparent. I'll also show you Hurst and FSC cycle tool roadmaps on that. I use two different cycle computer-generated analyses and integrate those into my work. One is Hurst cycle analysis, and the another one I've added just recently is the FSC cycle tool. The FSC is the foundation for the study of cycles. Be sure and check out their website and their offerings. Then I'm going to look at the current sentiment conditions on a number of food items, specifically corn, lean hogs, soybeans, and sugar. I want to show you how those are all poised to rally. And if that actually occurs, if that might derail the Fed's plan to ease moving forward. Then I'm going to look at gold versus the US dollar, and we'll specifically take a look at gold sentiment and see if it's suggesting that we get a little bit of a pause here, possibly a multi-week pause on this decline we're seeing in the US dollar. Then after seeing quite a few relatively negative items during the first part of the presentation, I definitely want to show you what items that I believe are likely to rally. between late September and late in the year. There's a quick list of those, and I'll show you my wave counts on those. I would like to add one additional item, and that is the Shanghai Composite in China is well positioned for potential rally as well. Finally, I will go over this again at the end, but if you have not been a paying subscriber at any of the four levels of service at Elliott Wave Plus during 2024, just send me an email. There's my email address, sid@elliottwaveplus.com, and I will refund 50% of your first monthly subscription payment right back to you as soon as you subscribe. Additionally, I'm going to be working mainly from screenshots today, and if you would like to receive access to this screenshots I'm going to be showing you during the presentation today, just send me an email and say, hey, I'd like to get a link so where I can view and download those screenshots you showed today. So before we move any further there, I want to make you aware of my website and what it looks like. This is my website, elliottwaveplus.com. And I want to point out specifically, if you can scroll to the bottom of any page at my website and click on this Terms of Service Disclaimer tab, please do that and go read that in full. If I were to summarize my disclaimer, it would be there's risk of loss in all trading. Once you're logged in at my site, there's a new bunch of headings up here, one for screenshots. I provide screenshots for subscribers on Wednesdays and on Sundays. I do a weekly comprehensive webinar on Sundays where I go over about virtually all of my charts, many hundreds of charts. And well, maybe not many hundreds, over 100 charts. And then there's access to the history of going back a couple of years of all my Wednesday and Sunday screenshots, as well as my webinar recordings. And also premium plan members get a nightly report with algo signals, momentum algo signals. One additional thing I want to show you before getting to the charts is the pricing and the four tiers at elliottwaveplus.com. It's at elliottwaveplus.com/pricing. You'll find this page as you start reading through some of the offerings and the descriptions of the offerings there at my site. So please check it out. It's elliottwaveplus.com. That's with 2 L's and 2 T's. So let's move on to bonds. So the first chart I want to show you is the, let me find it here. I call it Recession Watch. So this chart is the 10-year bond yield versus the 2-year bond yield. It's a weekly close line chart. And this chart goes back to 2018, mid 2018. And as you can see, when times are normal, which is the great majority of the time in the markets, the red line, that's the 10-year bond yields, will yield a bit higher than the shorter duration bonds. The green is the 2-year bond yield, and that is considered normal and healthy. That means that if a person was going to loan money over a 30-year period, they would expect a higher rate of return for taking that long of a duration of risk, and they would want a bit higher return annually than they would receive if they only loaned that money out for 2 years versus 10 years. So as you can see, and there's March 2020, that's when a major bottom occurred right after the COVID crash in the stock market. And after that, bond yields remained normal until July of 2022. And that is when the inversion bonds, and so many of you probably heard of the bond inversions. That's when that started in July of 2022. And that means that the 2-year bond yield jumped up above the 10-year. And bonds, this indicator down here is the spread between the 10-year and 2-year yield. And you can see it crossed below the 0 line, which means that when it is dark red like this, and it's below the 0 line, that bond yields are inverted. They're abnormal. Notice I've made a note up here. After a period of inverted bond yields, recessions typically begin when they uninvert. And when you look at this line, it continues to be below the 0 line, and it continues to be dark red. So bond yields are officially still inverted, and they've been inverted for a record length of time. Most recessions after inversions begins, most recessions will start with about a 12 to 18 month lag after inversion starts. And so they're between July of 2023 and January of 2024. That would have been where a recession normally would have started if it was going to be somewhat average. And you can see in October of 2023, we nearly had an inversion, but for whatever reason, the inversion we did not get an uninversion at that time, and bond yields have remained inverted for a record length of time. That record actually this particular period of inversion broke a record in March of 2024 as the longest on record, the longest period of bond inversions on record. So what's happening now? Well, very recently in early August, the Sahm rule triggered. That has been a very reliable, and by reliable, I mean 100% reliable, indicator that the start of a recession is very likely imminent. And the Sahm rule, it was created by an economist, last name of Sahm, that worked for the Fed. And she discovered by going back and back testing that if the unemployment rate ticks up enough over a period of time, that it signals the likely that a recession is likely imminent. So that triggered in early August, early this month. Also, very recently, also in that first week of August, we got the yen carry unwind acceleration. That was started on Monday, I think the 5th, it was August 5th. Yeah. And so 2 important shoes have dropped here. And the last shoe to drop, I think, is where we will see this uninversion of bond yields. And as you can see, very recently, this indicator has been moving up toward the 0 line. As soon as it crosses over, my subscribers will know that, because I put a screenshot of this for everyone from the basic plan on up, the pro plan and the premium plan, and they get a screenshot of this every Wednesday and every Sunday, so they will know as soon as bonds uninvert. And that also has been historically a very reliable indicator that the economy is slipping into recession. So that is my Recession Watch 10s versus 2s chart. I want to move on now to a couple of additional charts. Let's see if I can This is my TLT wave count. So this is bonds, kind of the most popular ETF for trading bonds in the U.S., non-leveraged. And I want to point out the way my charts look and some additional information that shows on my charts. So the black dates with the CL indicate that the Hurst composite line is expecting that we would see a peak on August 19 here, and then a drop through September 4, and then on up through approximately mid-December. And so this is a bullish wave count on TLT from the all-time high on bonds and all-time low on bond yields that occurred back in September of 2020. Actually, yeah, I'm sorry, March of 2020. We got a clean, clear 5-wave down structure: 1, 2, 3, 4, 5. And now we're getting an expanded flat, and it's very likely, based on Hurst cycle analysis, that we're going to see lower interest rates. In other words, bonds move to the upside all the way through March of 2026. And so this means that we're going to see a period of interest rates coming down. So I saw a question, what does this mean for the indices? Well, it's not good. Typically, people that have been taking the risk of stocks into their portfolio at some point will want to move to a risk-off posture during a recession, or B, a correction. And this kind of indicates that we're probably going to see a weak stock market over the next few years. And I've got more proof than that to show you. So people will many times move out of stocks into bonds, a traditional home for flight to safety. So that is the TLT chart. And then I also want to show something very interesting on the Japanese yen. But before we get to that, let me get back to, let's look at some sentiment on bonds, the sentiment conditions right now. So this is the 30-year bonds, the longest dated bonds. And this is an example of our proprietary commercials versus retail sentiment weekly sentiment conditions charts. So this indicator right here is how commercials are currently hedged. Commercials are typically they are producers or marketers or sellers of the item. So in this particular case, on bonds, I think commercials would be the smart money, the largest accounts out there, primarily banks, possibly even central banks, and they are currently on the short side, bearish on 30-year bonds. This next indicator here is daily sentiment index. So this represents the current bullishness or bearishness of retail traders. So notice that this indicator moves from anywhere from 0 to 100 on a scale. We recently saw retail traders right here, that's that little triangle right there, 86% of retail traders were bullish on bonds. So that means that retail traders have been front running the expectations that the Fed is going to ease. That's one idea or reason why they would be so bullish on bonds at this time. Another reason would be that they're gradually moving into bonds as a flight to safety. So commercials are short, retail is heavily long, and that is a perfect storm of bearishness. Notice I'm also, because commercials generally end up right. They're the smart money. The retail usually ends up wrong. There's a couple of other indicators here you'll see on most of my charts. One is the money flow index versus RSI. So the black line is the RSI. The blue line is the money flow index. So at critical junctures, like for instance, right back here, you'll see the RSI in deeply oversold territory. This is another proprietary indicator I programmed up. So the RSI indicator is in its oversold territory on a weekly chart. That means below 30. And if the money flow indicator is above the RSI while the RSI is oversold, that is a warning sign of a bottom. And then vice versa also occurs, where if the or the RSI is above 70 and it's in its overbought territory, and the money flow indicator is below that, that is a warning of a significant top. So this is 30-year bonds. And here's the point I wanted to show, that, and I'm going to close these, and open up the 10-year bonds of sentiment conditions. And you'll notice that there's quite a difference here. The commercials all of a sudden have jumped long the 10-year bonds. This is an important development, and what the commercials are basically, the message they're giving by getting long the 10-year but staying short the 30-year is they think that bond inversion is going to end. It's going to uninvert very soon. So they're getting along the 10-year versus the 30-year. That means that the 10-year bond yield should move down faster than the 30-year bond yield, because the yields are the opposite, move opposite to the bonds. So this is suggesting that we're going to get uninversion very quickly. Another thing I wanted to show you while I'm at this is the USD JPY. This is a weekly chart, and the red line, the overlay there, is TNX, which represents bond yields. Notice that bond yields recently have been coming down, and you can see historically how very highly correlated this pair, the USD JPY pair, is to bond yields. And so we had this significant top, and notice that that was very likely a 4.5-year Hurst cycle peak that occurred very recently, and an explosive move to the downside. That means a weaker dollar and a stronger Japanese yen. So we're seeing the yen move to the upside recently. And so as this moves down, we've also been seeing yields move to the downside, and therefore bonds to the upside. Notice this roadmap, it continues to be bearish. So there's some that are suggesting, oh, well, this unwind of the Japanese yen is already over and nearly done. Well, I think that's likely to be incorrect, because Hurst, even though I'm expecting a bit of a bounce here through mid-September, Hurst analysis is bearish all the way till the middle of next year, into the next 4.5-year cycle trough. So that's an important chart. Another important chart would be the sentiment on Japanese yen. So we had a perfect storm of sentiment there in mid-July that was predicting that we were going to get this bounce in the yen. commercials were heavily long and retail was all the way down to an 8, and that projected that we would start getting this unwind. The thing to realize about the Japanese carry trade unwind is that it was responsible for financing the bubble rally in the Mag 7 stocks. So what hedge funds were and large traders were doing is they were borrowing money at zero interest rates in yen, and then turning around and using that money they borrowed at zero interest rates into Mag 7 stocks. Well, if that unwinds, and it looks like it's going to, that is going to be trouble for the Mag 7 stocks. So that is the bond portion of my presentation. So the next thing I'm going to show you is the S&P 500, some multiple time frame charts on the S&P 500. And before we do that, I'd like for you to look at the long-term, well, that's not right. Here we go. This is Hurst cycle analysis on the S&P 500. And what it does is it figures out where some cycle troughs occur. And then it also figures out about 12 different simultaneous cycles that are working in the markets. And it averages each of those cycles together, and it comes up with a composite line. The orange line is the composite line. So we're about right here in August of 2024 right now. And notice that the composite line is suggesting that we're about as high as the stock market's going to go. Now, you have to take the composite line with somewhat of a grain of salt, and I'll get into some shorter term movements on the composite line in a minute. But the composite line is bearish from August of 2024 through April of 2026 next. So it's looking for a move down into this large cycle trough nest, a 9-year cycle trough nest. Then it's bullish through December of 2027. And then bearish all the way through the end of this decade, January of 2030. I think it's also important to note that in 2032, the year 2032, there will be a Kondratiev or K-wave 50-year cycle trough low projected in about the year 2032. So this matches up pretty closely with that. But you can see this is a head, and this is a left shoulder, and this is a right shoulder. So this is a pretty bearish roadmap when you take it at face value on the very long-term multi-year chart. But if we move into a little closer into what's happening lately, we also have a bearish picture on Hurst. And notice that it is projecting, taking the composite line at face value, is projecting downward movement through late September next, and then upward movement through late November. And then is quite bearish. And notice you can also see this head and left shoulder and right shoulder here, head and shoulders pattern. Just so you'll know, October 2023 was an 18-month cycle trough on this analysis. And within each 18-month cycle, you have two 40-week cycles. So this nest down here would be the expected next 40-week cycle trough. That would be due in approximately late September. Then there would be a second 40-week cycle to finish the 18-month cycle. And then inside of each 40-week cycle, you have a 20-week cycle. That would be the April low of this year. Another 20-week cycle, that completes a 40-week cycle. Then you get another 20-week and another 20-week to complete the next 40-week cycle. So you'll notice that the cycles, troughs, are nests. That's because Hurst discovered that and this explains why many times stock market bottoms are spikes, but stock market tops are rounded. Because and this looks like it will be no different. So then, and now we'll get to the actual wave counts, and we'll start with the long-term quarterly wave count on the S&P. This is up from the 1932 low. 1 in cycle degree, that's teal. 2, 3, an expanding triangle for 4 through 1974. And then everything since 1974 has been a highly extended fifth wave to the upside. So 1, 2, 1, 2, 3, 4, 3, 4, and then the fifth wave up. Now, the best target for the end of an extended fifth wave would have occurred at 5604 or 4604. That is where wave 5 at cycle degree would have and did reach um, uh, basically a 1.618 expansion off of the top of wave 4. So if you take the distance from the 1932 low through the 1974 low, consider that a unit of 1, and then take that times 1.618 and add that to that bottom, you get that 4604 target. That happened to be fairly close to a couple of additional important Fibonacci targets from the 1974 low. If this is a burgundy or primary degree wave 1, and this is a 2, then we got a highly extended third wave. The third wave was massive. It was 4.236 expansion off the top of wave 1. Then we got a expanded flat for wave 4. And so in an impulse in Elliott wave, if the third wave was extended, then you're likely to get a normal fifth wave. And that would be most typical in the stock market, where the third wave is the extended wave of waves 1, 3, or 5. And then you get a normal fifth wave. Well, what constitutes a normal fifth wave? That's where the fifth wave is 0.618 times the net traveled of 1 through 3. And that target was at 49.31. That has also been hit. Then up from the 2009 low, we would need a 5-wave up structure. And I think it counts pretty clearly as a 5. 1, 2, 1, 2, 3, 4, 3, 4, and then the fifth wave up. Best target for the end of the fifth wave up would be 54.05. That also has already been hit, and that would be where the fifth wave up was a normal 0.618 times the net travel to 1 through 3. We'd expect that fifth wave to be a normal fifth wave because the wave 3 was already extended. So moving next to, so we have a cluster of targets up here, all of which have been hit on the S&P, but on the Dow Jones Industrial Average, only using the same math, only the bottom most of those 3 targets has been hit so far. So that's the quarterly chart, monthly chart, up from the 2009 low. 1, 2, 1, 2, 3, 4, 3, expanding triangle for 4. All of this move up from the March of 2020 low is a thrust from a fairly large expanding triangle, and that explains why it has been so aggressive. So off of that March of 2020 low, there's my zone or Fibonacci target zone for the tops at 3 large degrees. The initial rocket ship move out of that low, which was propelled by 2 massive, approximately $2 trillion each stimulus packages, one in March of 2020 and one in March of 2021. We got a very aggressive ABC zigzag that traveled most of the way toward the top of that target, long-term target zone. Then we got a pullback, and there was an ABC corrective pullback. Now I'm counting this most recent move to the upside as wave 3 of a contracting ending diagonal. If that count is correct, then we would need to see a wave 4 that dips down into the price territory of wave 1 and before it puts in its 5th wave to the upside. That was the monthly. Now we're going to move to the weekly. So here's the ending contracting diagonal idea. Notice that the wave C up from the March of 2020 low, this zigzag A, B, C, came within an eyelash of being exactly a 0.618 expansion of wave A. So if this is length of wave one, this is wave A, consider that a unit of 1, take that times 0.618, and on a similar chart, look for a 0.618 expansion off of that top. That's that dotted line right there. And that is virtually exactly where it stopped moving up. That supports that this was an ABC zigzag to the upside and therefore would not be the top. I never called this the top. A matter of fact, in almost real time, it was pretty soon after that, I called that wave 1 of an eventual ending contracting diagonal. So we got a wave 2 down here through October of 2022, and I'm counting the move up since then as corrective. Each leg of a diagonal is typically an ABC zigzag or something from the zigzag family, and possibly a double zigzag or triple zigzag. So I think that we've already seen the top for the wave 3 of the diagonal, and now we're getting a wave 4. If my contracting diagonal idea is correct, we'll see a dip down into the price territory of wave 1 next, and there would still be a 5th wave up yet to come. In no way, shape, or form do I believe it is possible to count this move up from the March of 2020 low as a completed 5-wave structure, and that's what we need to see in order to call this very large grand supercycle wave 3 top here. So that's the weekly chart. Here is the daily. Where is it? Here we go. So I think the wave 3 of the diagonal ended here. And then this, very importantly, this wave 4 started with a 3-wave down structure, which I'm labeling as wave W, a zigzag. And then I think this X wave to the upside, another zigzag, is likely at or very near its peak. And then we get a 3-wave move down if this wave count is going to be correct, it would need to move down below 48.18 next. The next 40-week cycle trough, the composite line is suggesting that is due on September 22. There's that nest of lows that centers on about October 2. That means that the typical bearish seasonality in September, this would be in keeping with that, and then there would be a 5th wave up, an ABC zigzag, very likely to new all-time highs. However, in an ending contracting diagonal, truncation is possible. And as you may recall, when we looked at the medium-term Hurst cycle analysis, it was expecting downward movement into late September and upward movement into mid-November. And the composite line is suggesting that, yeah, we might get that truncation there. But this would still need to be the 5th wave up. So in other words, I think the stock market stays up and through later in the year, approximately around the election. And then it is bearish through August of 2025. Here's another, I think, very important thing to consider as we'll step back to a monthly chart. Now let's look at the weekly. And is that after we see a grand supercycle wave 3 peak, The next thing we would expect would be a grand supercycle wave 4. I think it's possible that that correction, and a very large correction, could last 8 years. And 8-year corrections are not unusual. Really, the entire 1966 through 1982 period was a sideways period in the stock market, and that was 16 years. And there's been many other corrections, you know, that have been somewhat similar to an 8-year period. For instance, the Y2K correction through 2009 was an expanded flat. That was a 9-year correction. So it wouldn't be out of the ordinary to see an 8-year correction. And if we get into a wave 4 that is an 8-year correction, that the only thing that I think is going to assist in when it's going to be moving up and when it's going to be moving down during that period is cycle analysis. Elliott wave alone is going to not be very good there. And here's why. In a wave 4, in Elliott wave, it can be any of the 11 corrective structures. It can be a zigzag. It can be 3 different kinds of flat. It could be a triangle. It could be a double or triple combination. So it can be a whole bunch of things. And there's no way to know ahead of time what it's going to be. And therefore, I think cycle analysis, which I use 2 different cycle tools, is going to be incredibly important in over the next several years in being able to successfully navigate these markets. So that's the S&P. Very quickly, want to move to Bitcoin. Here's my weekly wave count on Bitcoin. And that is that we're in a 5-wave up structure starting in December of 2018. 1, 2, 3, expanded flat for 4. No, it did not price it, move down into the price territory of 1. So this move to the upside needs to complete a 5-wave structure. If the 5th wave up in Bitcoin is going to be normal, then it would be a 0.618 times the net traveled of waves 1 through 3. And that target is at 100,698. So yes, I think the Bitcoin is going to move next up into approximately February of next year, up to 100,700. If we look at the daily chart, there's the 3rd wave up in blue, and then the 4th wave down, I think, is finished right here in early August. That was the end of blue wave 4. So I think we're in the early stages of blue wave 5 to the upside. There's that target of 100,700. That the 5 waves up here should subdivide as a pink 1, 2, 3, 4, 5. I think peak wave 2 probably isn't quite finished yet. I think it will finish in approximately mid-September. That is based on Hurst cycle analysis. Notice also that the FSC cycle tool is bullish from August 16 all the way through December 2025. That's the FSC cycle tool. I think I'll take this opportunity very quickly to show you the FSC cycle tool on Bitcoin. And this also agrees that we're going to move up from approximately about now through into, this is Bitcoin. This is, I need to change the dates on that last chart and update them all the way into early February next year. So the cycles, this is a completely dissimilar cycle analysis tool to the Hurst. It doesn't try to fit the cycles into a predetermined model. It simply looks for the strongest and most repeatable cycles and takes only those into consideration. And notice that it is also suggesting that this correction is probably about over, and we're going to rally through into the first quarter of next year. By the way, if that analysis is equally as bullish on Ethereum. So that is the Bitcoin coverage. Very quickly, I want to show you the charts on a few food-related items. Here's corn. This is your strictly weekly sentiment charts. Notice that commercials are heavily long corn on a weekly chart, and retail is quite bearish. This is kind of a perfect storm of potential bullishness on corn. Also on lean hogs. Another food-related item, we have commercials heavily long on lean hogs and retail very recently quite bearish. This is a perfect storm of bullishness on lean hogs. Also, I want to show soybeans. Soybeans has been getting creamed lately, but on all of the indicators are indicating that we should see an important large cycle bottom on soybeans very soon. The commercials are heavily long, retail is heavily short. We're getting the dark green zones down here where the RSI is deeply oversold, and the money flow is still above it. So this is bullish on soybeans. And then finally, sugar, we can see it's a perfect storm of bullishness hitting right now. Commercials heavily long, retail heavily short. The money flow is riding above the RSI. That is all bullish on sugar. So the question we have to ask is, if we start seeing food inflation coming in, is that going to mean the Fed is only going to be one and done in September? I would say that it's possible. So what's going to rally next? If there's a lot of bearishness I showed you on the longer term cycles, what is likely to rally next? So for that, I'm going to go to live charts on the Trade Navigator platform. Oh, hey, you know what's important? NVIDIA, because they release earnings tomorrow. I also wanted to show you NVIDIA and show you why I'm not including NVIDIA as one of the items that's going to rally big next. So this is a chart of NVIDIA weekly chart, and this low back here is a live chart, is the low in December of 2018. And I think you can see a very clear pattern here, a 1, 2, and then 1, 2, 3, 4, 5 for wave 3, an extended wave 3. That's up through late 2021. Then I'm a wave 4, and then an extended wave 5. So pink 1, pink 2, pink 3, pink 4, pink 5, and then within the fifth wave up 1, 2, 3, 4, 5. So and the best target for an extended fifth wave in NVIDIA was at 125-ish. And there's a couple of other Fibonacci targets very nearby for the end of the fifth wave up. One here, the pink, and another one here, the green. So the end of the green 1, 2, 3, 4, 5. So in my opinion, as an Elliottician, NVIDIA has completed not only a 5-wave up structure from the late 2018 low, it has also completed an extended wave 5 up from the October of 2022 low. So I am not including NVIDIA as an item that is going to rally big toward the end of this year. What I am including is Apple, and you'll just have to go back on the recording on this and take a screenshot of it, I suppose, or I could include the Apple screenshot of my wave count for you. If you email me, I can send you a screenshot of it. Another item I think is going to rally big through, but from basically the September-October timeframe up through late in the year is going to be Google. So these are, many of these are the same cast of characters, excluding NVIDIA, which has already finished a pattern. So there's so in Google up through late in the year after an additional pullback into September, October. Meta, the move up through late November, and an ending contracting diagonal. Microsoft is and I think is going to be a big winner late. So I think we'll be right back to, some core large caps that will drive this last fifth wave up into late in the year on the stock market. I've been asked for a chart on Mara. That Mara is a large Bitcoin mining company. And notice that Mara is only is projected to stay up only into early October, according to Hurst, and then be very bearish. I think it's very interesting that on Mara from November of 2021, which was the all-time high in Bitcoin, we got a 5-wave down structure, 1, 2, 3, 4, 5. And that has been followed by choppy, overlapping, corrective price action. So that is not bullish. That is not bullish. So why would Mara not be bullish, but Bitcoin would be bullish? And I think the reason is, and you'll see these notes on my daily chart of Bitcoin. There's an article you should definitely read, why Bitcoin is fundamentally flawed. And the fundamental flaw in Bitcoin is the amount of energy it sucks up with these data centers and so that is a huge cost of doing business for Bitcoin miners. And that article proves that as Bitcoin moves higher, it sucks an equal amount more of energy, and at some point it becomes unprofitable to mine. So I think that this last move to the upside in Bitcoin will be a consumer driven bubble top that may not include the miners because they will not be able to make money. And once Bitcoin moves up higher, and you might think, well, what about Ethereum? Well, Ethereum is also a proof of work crypto. All of the major volume cryptos are proof of work cryptos. Eventually, I think those will have to give way to a proof of stake or something like Cardano, a whole different setup on the way the crypto was designed, where it doesn't suck up that much energy off the grid. And as we rotate into those cryptos, that is going to hurt NVIDIA, because NVIDIA cards are a major component, necessarily a component where they have racks and racks of PCs with NVIDIA video cards in it, with tons of processing power to mine Bitcoins. I don't have a chart for Solana or Cardano and I'm running out of time here. What else was I going to show you today? Let's find out. I guess that's about it. If you have not been a paying subscriber during this calendar year, I would be happy to refund 50% of your initial monthly subscription payment. So let's say you subscribe to the Pro plan, it's $100 a month. I would immediately refund $50 back to you. To get that special, just send me an email, sid@elliottwaveplus.com. Elliott has 2 L's and 2 T's. Also, if you would like screenshots of my presentation today, send me an email. That, I think we're getting pretty close to time there, Jody. So I'm going to stop the share.
Thank you so much, Sid. That was wonderful. Let me stop the recording.